podcast?
Yeah, yeah. You're only 30 minutes.
Yeah. So we are ready with our podcast three, Sadat Speaks podcast number three. So today's topic is cash flow is king. Why receivables management is a CFO's growth strategy. So I'll just give a brief about what is going to happen in this podcast, what we are going to discuss. So as we all say that debt collection is not all about recovery, it's all about cash flow optimization. Like most businesses focus on sales growth but ignores the receivables discipline. So especially this episode explains how structured receivable management improves the days sales outstanding, the working capital, vendor negotiation power, profitability, and credit risk. So I'll welcome Stina now to introduce the panels here.
Before I could introduce, what if I told that the biggest threat to your business isn't competition, but it's the unpaid invoices? So, to dive deep into this topic, let me introduce the panel. So, firstly, we have Mr. Varun, who's heading the Saudi and Oman operations for now, and we have Mr. Niven, who's heading the UAE and Bahrain operations, and we have Tom Sir, who is the CEO, and he will be giving more insights on the strategic leadership. To get into the podcast, I welcome Mr. Ajmal, so he will be taking over.
Good afternoon, everyone. Thank you all for joining. It's our third episode of debt collection, and our topic is cash flow is king. So, why receivable management is a CFO's growth strategy. So, I would like to begin with a question like why sales without collection is dangerous. So, I will begin with Mr. Varun. Okay, so Mr. Varun in Oman, okay, do business focus more on sales growth than receivables discipline?
Yeah, thanks. Thank you, everyone. Thank you, Ajmal, for asking that. And I think it's a very relevant question. Yes, of course, businesses in Oman do focus on sales growth. They look at top line numbers more than the bottom line. For them, it is more of building the top line revenue. And somewhere while they do that, I think they tend to compromise the underlying credit terms, which is what causes issues later on with the cash flows.
Clear, clear, crisp. Okay. And the next question will be what happens actually when companies grow revenue, but they simply throw a blind eye or ignore collections. So what's the kind of real scenario we're talking about here?
See, it has a direct impact on your cash flows, where your cash flows are tightened, which leads to, delayed in, salary payments, vendor payments. Your profit becomes more of, it's just trying to show a higher top line number where profit becomes meaningless. And I think you start depending a lot on the borrowing. You tend to depend on, banks for getting more money into the system. So I think somewhere it is a cause of concern.
So ultimately, it's like a liquidity crunch.
Absolutely, yeah.
Lovely. Okay. And is it the same take for Mr. Nevin from UAE? Oh,
Yeah, yeah. Thank you, Ajmal. It's a wonderful questions you have asked. Okay, the first question is the business focus is on sales or on the receivables. Of course, in all the businesses, most of the businesses is focusing on the sales growth rather than the receivable discipline. Because sales is visible, rewarded, and it is very immediate. Okay, collections are often delayed and it may be overlooked. Okay, but this create risk. Revenue may grow, but if you are not collecting on time, the cash flow suffers. But smarter businesses balance both. Okay, both the sales as well as the revenue plus the collections. Okay, so cash flow is also very much important, equivalent to the business as well.
lovely. And what could be the hidden cost of receivables management? And so the people, they see, okay, the cash is coming in, or it's going to come at some point of time. But what would be like, there are so many hidden costs actually associated with a delayed collection or a delayed recovery. So what could be let's say that in most of the time there is there is something stopping companies or the leaders stopping from assigning or escalating it. So what are the hidden costs?
See, when companies grows revenue but ignore collections, it will create only illusions of success. Okay, so revenue, it is not, we cannot say that it is cash flow. Once the money is collected, then there is a meaning for sales. Sales may look strong on papers, but without collections, there is no real liquidity. But what will happen? What amount you need to pay? For example, the cash gets stuck in receivables, working capital get blocked, payments to suppliers get delayed, borrowings and finance costs may increase. So these are the hidden costs. Delay payments silently eat the profitability and the stability. And in the end, a growing business can still face a crash crunch simply because it is not collecting the payments on time.
Well said. Well said. Thank you for that. I will move to the next topic, which is the real, like again, I'm coming back to the real cost of delayed payments. We just spoke about the hidden cost. Now, what is the real cost? So I will again begin with Mr. Varun. So what are the hidden costs of the high DSO? We would like to hear from your side.
See, when cash is stuck, typically, the companies tend to, lean towards the banks, their credit lines, which means there's an interest cost to it. And when you're banking on that and you're leveraging your overdrafts, you are compromising on your margins. That is one. Second is, see, there's an opportunity loss which happens. If you can get that cash back into your system, you can use for automation of processes. You can further use it to grow your sales. You can use it to make your processes more efficient. So I think it's very important that you have to keep your eye on your cash flows and ensuring, yes, of course, top line numbers are important, but at the same time, not to compromise on your cash flows.
Well said. And also we have seen in the past that like most of the companies, they are offering 50% discount, 60%, 30%, 40%, which is way beyond their eating up their profit, they're eating up their working capital, and much beyond that. So I think this, if the companies or if the leaders, they take a call in the right time, they could just resolve this in a matter of a fraction of amount, or they would simply use any collection company as Sadad and recover on time without any additional loss.
Absolutely. Absolutely.
And another question is associated with the same. So how, again, this delayed receivables, they impact vendor relationships and credit lines. And of course, yeah, the history as well, the credit records. So what's your take on this?
See, this definitely has, an impact on various aspects. One is, see, if you have cash flows are tight, you tend to delay your payments to your vendors, to your business associates, which, erodes the trust and the credibility you are trying to build in the market. So it starts with this. Then naturally, it further, trickles down to your vendors, cutting down on your credit periods, or the kind of service they are trying to, you are expecting as a customer. And of course, it does also trickle down to how, even your supply chain, impacting your delivery time. So it's actually like I would say it is effect which goes down to the very last point where your business starts suffering.
Correct, correct. Well said. So my next question, with the record of 18 to 20 years of credit management in the UAE, my question is obviously to Mr. Niven. How does structured follow-up reduce aging buckets? Let your experience speak about answer this question.
It's a very good question. It is not for the collection. For every activity, there should be a structure. Okay, so
Well
see
said.
how it when it comes to the collection, structured follow-up brings consistency and timing into the collection. That is why the aging get reduced. How it help? So, for example, early reminders that prevents invoice from skipping into the overdue. Then regular follow-ups will keep the customers accountable and reminding on the outstanding. And escalation at the right time avoids long-term delay. And clear tracking of these follow-ups and everything ensures that the no invoice will be missed out. The result is invoices are resolved faster and get the payments on time, and the outstanding will not get to 30 days or 60 days or 90 days buckets. In short, the consistent follow-up will help your business to move faster, get the cash flow on time, and move faster.
Well said. Thank you. We'll move to the next segment, the third segment of our session. So this time the question is why outsourcing makes financial sense. So this question is to our COO, Mr. Tom. So the question is, from a leadership standpoint, when should a company outsource collections?
Well, thank you, Ajmal, for this question.
Okay.
When should leadership start thinking of outsourcing debt collection services? I think they should do it from the time, according to me, they should do it from the time they think of giving credit. Because prudent credit can make sure that your collections are on time. Now, it is like professionalism. I always give the example to my team, especially the sales team and the operations team, that you go to a hospital, probably the nurse knows better than the doctor about the diseases and the treatment. But then you always turn to the doctor for prescriptions because he is the professional who has the relevant knowledge to make sure the right prescription is given. So similarly, going to an outsourced agency for your collections is like going to a professional. When you want to do your financial accounting final accounts, you go to a chartered accountancy firm. The same, it's not because we don't have professionals in the system, but chartered accountancy firms are preferred or required because they are the professionals who can do it well. The same way, debt collection service agencies have the required skill set to give you the right solution. And it will definitely be less costly compared to your own team. And I think from the very inception or from the very beginning, we should think of attaching yourself with an outsourced agency.
Since you said about cost, my next question would be, is it cheaper to manage it internally or outsource it to an expert? Or I would say, is it affordable? Is it an affordable? Is it a wise decision?
See, what I've noticed happens, you have an internal team which will manage your debt for some time. Then you find it's running into rough weather. Then you outsource it to a third party. Now, put together, your costing will be much more than actually you outsource from day one to a debt collection agency who can actually service this better. So your total cost will be less if you're outsourcing it from day one, rather than waiting for it to become an overdue and then think of outsourcing it. So I would say your cost, if you do it prudently, will be less if you outsource it. Plus, you will have an efficient cash flow, which which can be also be useful for the company. So if your cash flow in terms of your other costs or your opportunity cost gets reduced. So overall, if you use a proper professional outsourced agency, your overall cost to the organization will be comparatively less.
Understood. So we spoke about cost, we spoke about efficiency, we spoke about management. Now the most important part of the deal comes in. So how does outsourcing protect brand reputation? Everyone is concerned about their brand because they take years. Some people take 5 years, some take a half a century to build a brand reputation. So definitely when it comes to assigning to a third party or escalating to a debt collection agency, how does outsourcing protect brand reputation?
Question to me.
Yes, sir.
So outsourcing, I really do not understand outsourcing. How does it actually affect your brand reputation? I think it's a myth if people think outsourcing actually affects your brand reputation. So you outsource your back office operation, you outsource your billing, invoicing, delivery, all of these things. It doesn't it affect your brand reputation? Same way, outsourcing debt collection also actually will not affect your brand reputation, provided you give it to the right type of an agency with professional approach to debt collection service. It's actually a misunderstanding or a totally wrong notion that people have that outsourcing collections actually affects your brand reputation. In fact, to me, it actually protects your brand reputation. Why? In case you, because the person who is not going to pay you money, and suppose your own employee fights with the agency, it becomes more, sorry, fights with the customer. It's more telling on your brand rather than a third party actually goes and fights with the customer to get the money back. In fact, outsourcing actually would be protecting your brand reputation rather than destroying or affecting your brand reputation. I think the right way, if you tell the client or the customer that outsourcing your collection actually protects your brand reputation rather than it affects it. I think it's a matter of how it is perceived. It's a very perceived matter.
Of course.
To
And
me, if you show me a client, I would be able to convince that please outsource your collection. That actually is going to protect your brand reputation better than doing in-house collections.
totally makes sense. And when it comes to Sadat, we make sure that like our entire team, locally, internally, externally, are compliant with the local rules and regulations. They're compliant with the GDPR. They're compliant with the international standard rules and regulations. So everyone is closely monitored, well trained, and of course, the Sadat, the brand speaks for itself. My next question is to Mr. Varun again. So, what mistakes do companies make when handling collections internally?
Well, what I can tell you from my experience over the years is that when companies are handling collections internally, Ajmal, typically, it's more focused on client relationships, okay? And they tend to ignore the receivables, which start building onto overdue till the time it becomes a big problem. And suddenly they feel that they realize that the cash flows are getting tightened. That's when they all start working towards it till the time these are well aged invoices which start piling up, so that is one part. Second part is because they're also focused on top line numbers, there's no ownership with anyone. They all feel, okay, I'm doing one part of it and the second part is going to be taken care. So somewhere the entire focus on overdue gets lost. Third part is a lot of companies try and push this to their sales itself. They say, okay, let sales only handle collections. Now, when that happens, all the entire sales mindset is, okay, let me first do my top line numbers. What happens because of that is they start compromising on the underwriting, the credit parameters, because for them their focus is, I do my sales numbers, I build my top line, we will look at it later. Now, because they have compromised on the credit parameters, and these invoices definitely go into overdue, and further they lead to bad debts. So this is something where there should be a very clear demarcation. And of course, companies want to save on overhead costs. That's why they even pass it on to their sales team, or just put one person in charge just to try and overmanage. But they don't realize that because of these cash flows, these overdues which keep piling, it starts affecting their cash flows. It starts eating into their margins because of interest costs. It erodes their credibility in the market because this has a spiraling effect on their payment overdues. So overall, I feel it's a very good way to handle collections and to keep it watertight is to outsource it and to utilize an expert agency who abides by their code of conduct, who has a very clear demarcation on how we have to approach, so that the customer chooses to benefit by the end of it.
Well said. Thank you. Thank you so much for a detailed explanation. That's certainly going to add value to our listeners. So, moving to the last segment of our podcast, and this topic would be what CFOs should monitor. So, this is a quick rapid round, and one metric every CFO must track. So, I will begin again with Mr. Varun, aging ratio.
I think aging ratio is very important. It helps you identify risks early. By the help of it, you can deep dive into certain buckets, which need more focus and take corrective measures. And of course, aging ratios also help you to take well-informed decisions, how you want to, give your further credit to your clients.
Lovely. The next would be to Mr. Nevin, recovery cycle time.
Recovery cycle time is nothing but how long it will take to collect after invoice is due, or we can say that how long it will take to collect money from the customer. So it will give the efficiency of the collection team. So if the collection recovery cycle is lesser, then there is a better cash flow. So always a CFO must track the recovery cycle time.
Great. The last one to Mr. Tom, cash to cash cycle.
Well, I think that for the CFO, that's the most important thing. In fact, I'll go back and say that in old times, business was measured on the efficiency of the business was measured on how much cash I have to spend for the day and how much cash I have received for the day. The owner used to count how much I received today, how much I spent today. In the place of the owner, now it's a CFO. He has to actually be very conscious as to what cash has come in and what cash is being spent on a daily basis and what is my balance end of the day. So that actually will give the health of the organization. He
Well,
defines the health of the organization.
well said, well said. And that winds up our session. Thank you so much. Actually, I want to thank each and everyone, Mr. Varun, Mr. Tom, Mr. Nevin. That's a lot of insights. That's years of, at least, let's say, like 50 years of combined experience and knowledge shared. And we are extremely thankful and grateful for all the information you have shared. With that being said, I would like to hand over to Miss Tina.
Yeah, as Ajmal told, this was really a wonderful discussion. Very clean, very informative. To anyone watching this, is easily understandable. And to conclude, I would like to say that growth is not always about how much you sell. It's always about how much you collect. And here for us, cash flow is the king, and receivable discipline is the crown. So thank you everyone. A special thanks to Ajmal for hosting and for everyone joining on time. And I'm looking forward for the next podcast. Thank you.
Thank you.
Thank
Thank
you.
you. Thank you for
Anil?
having us all.
Yes, let's get to
Thank,
Anil.
thank you.
Yeah,
Let me conclude it. I have something to say. Like as special thanks to all of you for joining. Couple of reschedules, but we made it happen. And a special thank to Tom sir for his anecdotes, making bringing in stories so that people who are novice in accounting and this finance will also understand actually what we're talking about. So all the stories we require much more stories in the future. And the special topic when the brand reputation came in. So I like to tell like as second to Ajmal, like Sadat takes brand reputation very seriously, and whoever listeners who are listening to us, you can definitely look for Sadat. Uh, and we make sure that we don't jeopardize your relationship with your customers and your business is as usual what you are doing. So bringing that to end our podcast, so I'd like to have some closing lines. Like if your DSO is rising or your finance team is overloaded, maybe it's time to rethink how you manage your receivables. Stay tuned for your future podcast. Thank you.
Thank
Sadat
you.
Thank
speaks.
you. Thank you,
Thanks.
everyone.
thank you.
Thanks.
Bye.
Thank you, everyone. Bye
Bye bye.
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 Bye.